If you would have bought $10,000 worth of CSL shares in 1994 and hold it for 20 years till 2014, that $10,000 will turn into $1 million or about 26% compound annual growth per year. And in this video, we are going to talk about how CSL, Commonwealth Serum Laboratories, has become a multi-bagger stock since its IPO in 1994. The reason why I'm making this video because it aligns with this channel goal is to help you become a champion investor, not through signal trading or stock market chart speculation, but through intelligent investing. And hopefully this video will explain a bit why I'm quite critical most of the time when examining investment ideas. Let's go back to the slide of how $10,000 turned into $1 million. It turns out in 1994, the minimum wage was about $7 per hour or $266 per week or about $14,000 per year. So we can say saving up $2,000 is more realistic than having $10,000 lying around. But still, investing $2,000 would have yielded $200,000 in just 20 years. CSL privatization happened in June 1994. The Australian government made a difficult decision to let CSL go private. And they did raise about 300 million Australian dollars or about 225 US dollars. Around June 2014, the market capitalization has grown from 225 million US dollars to about 24 billion US dollars. And that's about 107x. And your $2,000 stake would have worth 200,000 in 20 years. But if you have the guts of the champion investor, you would have held tight to CSL after 2014, and that $2,000 stake in 1994 would have turned into 800,000 US dollars in March 2022 because the market capitalization has grown to about 92 billion US dollars. And most people would have just cashed out their position when they reach 100x. But what if you are a champion investor? Meaning you spend less than what you earn and you don't waste your money on luxury goods. It would have made more sense to just hold that stock that worth $800,000 in 2022. How do we find this multi-bagger stock and invest like a champion? I narrow it down to 2 points. First one is to buy right. The second one is to hold tight. Remember, you have to hold tight from 1994 to achieve 400x and that insane level of dividend yield. So let's start with number one, buying right. The definition of buying right varies from people to people, but I think this sentence nails it. Buying right means buying a strong cash flow generating company with lasting economic moat at the right price. Imagine if the government sells CSL at $10 billion. It'll be much more difficult to reach 100 bagger status because the market capitalization is already expensive on the first place. But if you go back to 1994, the historical interest rate was pretty high. It was at least 8%, and when you have interest rate that high, it is more appealing to invest in government bonds. And that also means the stocks were trading on cheaper multiples, lower PEs, in the early 90s. If you look at CSL earnings in 1993, they reported a profit of 15 million Australian dollars. So going for IPO about 300 million, meaning a PE multiples about 20. And that is considered quite expensive for the early 90s. But if you look at the business of CSL, it has a really strong moat. CSL was the only blood products, vaccine and antivenoms manufacturers in Australia, and they've been doing it since 1916. Imagine how many wars they've been through. And on top of that, it has a profitable pharmaceutical business. And the privatization happened because the government would like to reduce the budget deficit, and instead of borrowing money to the bank to build the new Broadmeadows facility, they rather raise capital in the stock market. And this is the thing, it's really hard to find the multi-bagger. The investors in the early 90s cannot imagine what CSL acquisition will do, what is the earning projection for the next 20-30 years, and more importantly, they wouldn't have a clue what kind of innovation they will produce from the research and development of CSL. Who knows that COVID pandemic will happen in 2019, causing the major needs of reliable vaccine supply. Second point, holding tight. To be a champion investor, you need to hold tight on your winners. And obviously, for the past 10 years, the profit of CSL keeps growing and growing. And the momentum of increasing profit for the past 10 years really makes CSL selling for really high multiples. Remember back then in 1994, the PE was about 20. Now it was trading at least of PE of 30 or even 40. And can you also hold on to CSL during a stock market crash in the bear market? And now we have war and high inflation and potential interest rate hike. Can you hold on to your winners during this uncertain period? It's very difficult to do so. Even one of the greatest fund managers in Australia, such as AFIC and Argo, has position in CSL. AFIC has a stake about 0.4% and Argo has a stake about 0.25%. But did they hold onto their CSL position since 1994? Obviously they didn't, because if they do, AFIC and Argo rate of return will be greater than 5 to 10% that they've been doing for the past 10 years. I hope this video shed some light as of why I'm so critical with a lot of investment ideas, because I'm looking for another CSL. And now it's a great time to start looking. Interest rate will be increased because of very high inflation. Energy and commodity price will eventually become too expensive, and in turn the stock market valuation will be a lot cheaper, and I think that is an opportunity there. So if you found another CSL, another 100 to 1 billion company that can turn its value market capitalization to $50 or $100 billion, let me know and leave the comment below.